Next, we're going to look at what the future of wealth will look like and the role of open finance and what it will be in determining it. Moderating the panel are Alokik Advani, managing partner, at Fidelity International Strategic Ventures. Joining Alokik is Anand Sambasivan, the co-founder and chief executive officer of PrimaryBid, as well as Gaurav Rastogi, the founder and chief executive officer at Kuvera. Hi, Alokik. Over to you and your panel.
Thanks very much. Hi, everyone. I'm thrilled to be here. Thanks for having me at the Singapore Fintech Festival. I'm also really pleased to have with me Anand and Gaurav, who bring very different perspectives on this topic on the future of wealth management. And I will ask both of them to introduce themselves, but maybe just to frame the topic itself. I thought it's helpful to be able to talk through when we think about kind of the expanses of wealth management and what's happened across the open banking space. We've been able to aggregate up some of our bank accounts for players within the fintech ecosystem. The next piece of that is payments and how that's going to interplay with the rest of your financial services infrastructure as well. But thinking a bit further, and this theory of open finance basically is predicated on the thesis that you will be able to aggregate up many different facets of your personal financial picture to be able to give a consolidated view of your own spending, saving, investing, insurance, and other capabilities as well. And so that's the topic that we're looking to talk about here, sort of the future of wealth management. I'd love to turn it over to Anand first, and then Gaurav, just to spend 1 or 2 minutes of just introducing themselves and the platforms and the companies that they founded, and then we'll jump into some questions on the topic. Anand, can I turn over to you first?
Yeah, sure. Hi, Alokik. Hi, everyone. I'm Anand. I'm the CEO and co-founder of PrimaryBid. I grew up in Singapore, so I was really hoping I could be there in person. It's a shame, but it looks like my chicken rice and bak kut teh have to come another day. But yeah, I'm here to talk about PrimaryBid. And the PrimaryBid is a company that is reimagining how retail investors or individual investors participate in the capital markets. So we work very closely with the ecosystem. So on the supply side, that's the banks, and on the demand side, it's with the distribution platforms, similar to what Gaurav has built in India. And we allow, for the first time, individual investors to participate at the same time and same price as institutions in capital formation activities like IPOs and follow-ons. And now, as a company, we are very successful here in the UK. We're expanding very quickly. We've done over 100 deals on the London Stock Exchange, FTSE 100, FTSE 250, and so on. And we will soon be active in France and looking forward to opening up our platform across various other geographies.
Fantastic, Anand. Thanks very much. Gaurav, may I turn over to you to just introduce yourself and Kuvera, please?
Yeah, thanks, Alokik. And yeah, very happy to be here at the Singapore Fintech Festival. I'm actually in Singapore right now, and trust me, this is not the time you would want to be in Singapore. But quickly about myself, so I'm the founder and CEO of Kuvera.in. So at Kuvera, what we're building is a trusted personal finance management platform for the fast-growing mass affluent segment in India. So this is very relevant to kind of what Alokik started out with in the role of open banking in finance. So our guiding light is to be that one stop for our users' financial consolidation, execution, and advisory needs, right? And this can be across investments, across insurance, across loans. Essentially, how do we use data to help a user make better financial decisions? And this can be across their life events, right? So when we are talking about it, we are talking old school relationship banking, but it's built on modern rails, built on modern data. And how can you bridge that gap, right? We are a 50-member strong team, and currently we have about 800,000 users, and we managed north of $2 billion across mutual fund stocks and gold for them, all in India.
Fantastic. Gaurav and Anand, thanks very much for that intro. And it's a pleasure to have both of you on the panel. I spent a lot of time working with you both as as portfolio companies in our strategic ventures portfolio. So let's turn over to some of the questions and jump right into the topics. As we've seen the proliferation of open banking and sort of get significant traction, either driven by some of the regulations in UK and continental Europe, but also driven by some of the commercial outcomes and regulation that's coming up and in process, whether it's in Singapore, it's in Canada, it's in Australia. It's kind of interesting to see where people have started with the access to current accounts. When you think about some of the forward, and maybe I'll turn this first question to Anand, if that's all right. When you think about the other facets of finance that sort of come beyond that, which areas do you think are best suited next in terms of opening up those channels first?
Well, the clear and obvious one for me, Alokik, is, let's call it open broking. It's the one I'd really like to see. I mean, this global resurgence of the public and public markets is here to stay. I don't think it's going anywhere. I think it's just going to increase, particularly with better information and better access by the platforms. And look, it's been facilitated by all of these new incredible companies that are coming in. Now, at PrimaryBid, we want to help retail trading platforms complete that offering set. So to make that happen, we need to be able to provide well-distributed wholesale amounts of capital in short periods of time. So think of it, if you're an institutional investor, you can turn to the investment bank, prime brokerage services, you can buy and sell shares. The bank will also offer that same investor access to the wholesale market when companies raise capital, that discounted price. It's a full service suite of opportunities. Whilst for the retail investor, they're only getting that first bit. Now, to do that and do that effectively, we need to have this open broking construct where this sort of, it's really well woven into the fabric. The API channels are open quickly, where we can actually access individuals across various platforms very quickly, show them the product, let them participate, and then come back. So really what's happening in open banking, I think it's a very nice adjacency to look at that in the brokerage sector. It is happening, as you know, Alokik, in the US. It's it's pretty prevalent there. You've invested in Drive Wealth and so on. And I think that's been a huge success, and I'd love to see that in other countries as well.
Yeah, that's really interesting. And maybe just on that, I'll turn to Gaurav to give his perspective as well, where, when we look at the Indian market today and some of the things the cool things we're doing through the Kuvera platform, it's not so much driven by regulation thus far, but you've got these neo banks coming up that are trying to provide you some sort of aggregated view, through the platform, through your own platform. You're offering a whole range of capabilities and services much beyond traditional wealth management. Do you want to just give a flavor of how you see that in a market where it's not quite regulatory specific driven today, but maybe in the future, but also how people are sort of being more commercial in that view?
Right. So I think the demand for consolidation is there, right? And that's been there for a very long time. I think kind of started about more than 10 years ago when you had the original Mint launch in the US, right? And that was driven mostly by users giving access to their data. It was not driven by regulation. It was driven by a core need where people said, you know what, I have so many relationships. It's really hard for me to figure out what's going on in my financial life, and how do I make sure that whatever decision I'm taking is based on all the available data rather than just a fraction of it that I see on my broking side or a fraction of it that I see with one bank or with one of my financial relationship, right? So I think in India right now, that's the stage we are in. And to be honest, I think most of open banking is at that stage right now, where it's mostly driven by the users. There is a lot of work that is being driven, either through regulators. And in India also, there is some regulatory push in creating these centralized pools of data, where effectively the battle is this, right? Do the end users own their own data? Or do banks own all of the data, or banks or the financial institutions, or not just the banks, right? I mean, financial institutions in general, do they own the data or of everything that happens on their platform, or is it the user's data and it's the user's choice to kind of, so in India, there is a regulatory push to kind of, create these, in some sense, these data warehouses. and then give the power to the end user to say that, okay, I'm okay to share my entire financial data with this counterparty, and then that financial institution can use all of that data to bring about better products for the end user. So I think the benefits that can be achieved through this are phenomenal.
Right. Right. No, that's super helpful, and I think it's fair, right? When you look at the different countries and how they're approaching this, some of it gets commercially driven, some gets regulatory driven, but I think everyone's trying to achieve the similar end goal, and sometimes starting at different points in the spectrum. So maybe moving forward a little bit, and asking a pretty broad-based question. Maybe Gaurav, we start with you first on this one. Retail investors have definitely made their presence felt in the sort of the trading, brokerage experience and the wealth experience over the last, I'd say 12 to 24 months. Most notably, the whole Robinhood effect recently and other wealth sort of trading platforms. In your opinion, what do the mass affluent kind of next generation of investors, whether you're going from sort of, Gen Z through to the millennials, what do they want in an investing savings platform? Like, what are they looking for? Maybe Gaurav, for you first, if that's okay.
Sure. I think that there's no clear-cut answer, right? Because I think a lot of people who are also getting into investing at a much younger age, or have gotten into investing or trading for different reasons, right? I mean, it's been a bit hard to pinpoint what's actually driving this. Is this because they have more time on their hands? Is this because this has kind of become an equivalent to some kind of an online game or a digital gaming experience, which kind of attracts people, because some of the newer apps are built like that, right? So they're built to kind of get you in and kind of trade just like you do something else with the point system, with the scoring system, in this case using real money, right? So but we do see that ours is not a trading platform, ours is not a broking platform, but we have seen very strong tailwinds through the COVID kind of period, and we've seen a lot of people come in with genuine interest about, hey, you know what, will I have enough money for my life goals? Will I have enough money for my retirement? And they are building these portfolios, while they're also kind of, have some part of money, which you might call it the speculative part of their capital, which they're using to trade in the market. So it's in a way, I mean, what also happens is, right, and especially what's happened in the past 6 months, and especially post-COVID, is that the markets have gone up in a straight line, and that has also created this impression that making money in the markets is easy. And this is not the first time it's happening, right? I think what we always think about is that every generation kind of has their own moment where they think that they've realized or they've learned trading and making money for the first time. But this has been going on for a very long time. So the things that, whether it's trading, whether it's investing, they do want a frictionless experience, right? And the reason why a lot of these newer age apps like ours or like trading platforms are winning is because they're taking away all those frictions, and not just frictions about execution. There's also a friction about learning about the market. And as Anand says, right, I mean, a lot of that friction is just access to products. Right. And as those friction points go down one by one, just the volume increases. Just kind of, people who are willing to do this. If you can open an app, you're onboarded in 5 minutes, and you can start investing in 10 minutes, you're more likely to kind of start investing, rather than if it takes you to do a paperwork, send that paperwork somewhere, it gets approved, and then you transfer money into that account, and then 3 days down the line you can place your first trade, right? And that change is very, very critical.
Right. No, that's helpful. I mean, Anand, maybe just a different tilt on the same question is, you obviously interact with retail investors directly through the PrimaryBid, and you also offer a flavor of people's access directly into other brokerage accounts via an API as well. How do you think about that end user experience and what they want, and how do you manage that? Because you can control one part of it, you can't necessarily control the other part.
Yeah, it's a great question. Look, okay, let's say on the top of it, anyone who's investing is ultimately seeking a financial return, right? So, but now, as we've noticed and as we've said earlier, individuals are increasingly and rapidly taking matters into their own hands. They're owning their own destiny. They're opening up their Kuvera accounts and so on, and that's largely down to how frictionless it is to access the market. Now, what's really resonating here is this ability to invest on a level playing field. Now, I still don't understand why are primary deals, for example, which sell at a discount, only available to wholesale buyers. I mean, let's look at DoorDash and Airbnb just now, right? So, someone tell me, why did only institutional investors get to buy this and double their money in a few hours? And there was literally over $100 billion of value created in the first day of trading with these two deals alone. And I would venture to guess, the institutional investors got the lion's share of it. I mean, just turning it to you for 1 second, I could ask, from a Fidelity perspective, how much of your institutional clients got access to these deals versus your retail clients? And I'm pretty sure I know the answer. And the same thing happens every day on the follow-on space. So this is an old-fashioned worldview. The public very much agree. We wrote an open letter, as you know, Alokik, on this topic, which got a lot of mainstream support from captains of industry, including, of course, Ann Richards at Fidelity. And importantly, many thousands of retail investors who are still signing it today. So they want this level playing field of access. So that is a major motivation. The other major motivation that we see are individuals who are seeking to be personally invested in a company. That's really important to them. Now, these are stakeholders who are connected to the company either as employees, as customers, or users, consumers, that kind of thing, and want to be part of that success. Now, we've been incredibly lucky to have large companies like Taylor Wimpey, Aston Martin, and a number of other FTSE 100s to use us not only to enfranchise retail shareholders, but also for their employees. And soon we're going to be launching a customer offering, and we can see that these communities want to attach themselves to these companies and vice versa. And it amazes me that even today that access isn't there. So I think those are the main two motivations I see happening in the retail.
No, I think you're absolutely right. And the question to me, right? I mean, I think that purview that used to only be the access to the institutional crowd is very much being sort of opened up. And some of the voices, like you mentioned, our CEO at Fidelity International has been very vocal about ensuring that we can broaden that out, because with the quantum of capital that needs to be raised to help support some of these businesses, help them grow, help them thrive and succeed, it cannot only be the capital coming out of the institutional side. It needs to be capital coming out of the retail side, both from an access, growth, and return perspective as well. So I think that's a very fair point. Just turning gears a little bit to the next part. So, some of the motivations around this thesis around open finance was, okay, let's create aggregation. Let's create a better picture of yourself, your whole personal financial picture, this holistic perspective on the individual. And one of the things that I think is driving some of that motivation is better data access to hopefully drive better advice. And maybe, Gaurav, coming back to yourself, where, at your core, you're helping people sort of save for their goals, save for their planning for the future, for their retirement, for their home buying and other things. Is this truly possible to create that aggregation to provide better advice? And how do you think, young companies like yourselves can go about doing that well?
Right. So I think that's where this is kind of the key question, and this is where all the conflicts come into play. The end users want consolidation, right? And I would say that let's just start with the first order effect of consolidation. Let's forget about what advice can be built on top of it. There's tons of really amazing advice can be built that can be built if you have the right data, if you have all the data about your end user. But forget all of that, right? The end users want it just because they want to see everything in one place. For them, it's about simplifying their financial lives. It's about, because there are too many stories that float around about, elders in the family where they have multiple bank accounts, multiple brokerage accounts, and then it's a pain just to track everything. Right? So I think the first order effect itself, or that motivation itself, is so strong for most users that becomes a very strong value proposition for them. And of course, once we get to see a lot of that data, or once a lot of that data is shared with us, then we can build a lot of very interesting services on top of that, right? Now, the conflict that comes is, the end user wants to share that. The end user actually believes in aggregation, but some of these financial institutions that are already there, what I mentioned earlier, right? It's they treat that data as their own. They don't want that data to be freely accessible to everyone, and that's where I think regulation plays a big role. In fact, I think it's probably one of the only ways where you can actually enable a proper account aggregation framework. And I think, I mean, if I'm not wrong, UK is probably taking the lead on this. We are definitely following up fairly closely, and I don't see this reversing. I don't see this reversing from the end user's perspective at all, right? It's just that the financial institutions have to become better at saying that, you know what, we can't just be making money on access, right? I mean, that spread over time always goes down, right? I mean, you start by that. You start by saying that, okay, you're using my products. That's what we're making money on. But then you can't say, oh, this is a closed ecosystem now. You can't go out of it.
Right.
And that change has to happen. It'll happen slowly. I don't think that this is going to be built. These rails are going to be built overnight. But at least we're moving in that direction where eventually they will get built.
Yeah, no, and I think that that's a really interesting point, right? And that construct of, and you brought up this point twice in things, which is that sort of consent construct, right?
Right.
And I feel like in the traditional big tech world, that construct of consent, which started with a US-driven model, was almost just given because I click the T's and C's. You have my data, you can do with it what you want. There's a huge fight being fought now in terms of that, you know, whether it's dominance, monopolistic behaviors, etc. in that big tech world. In financial services, that entire construct of consent is much more applicable. It's much more, you know, kind of regulated and constructed in the appropriate manner. And I think it makes sense there. So with the right levels of consent, being able to provide that aggregation and hence forms of nudges, guidance, advice, no matter what you call it at different stages of regulation, is hugely powerful, because advice, in my opinion, is something which is majorly up for renovation, right? Both from the form, the substance, the pricing, the structures, etc., are all up for that. If we, and Anand, maybe this one's for you. You know, when we think about how tech change has driven, you know, kind of the bleeding of retail and institutional worlds of investing and trading, just, you know, how far has that come? How close has it become? You know, how similar are access, tools, you know, pricing that people can get and see? And obviously you're in the middle of some of that, being able to democratize that piece, but how real is that in manifesting that vision?
Look, I think it's an inevitable sort of journey, right? If you look at, you know, various markets around the world, the UK now is close to 20% of equity markets is directly held by retail. In the US, it's close to 40%. You know, active fund managers are holding a less and less piece of the institutional pie. There's more money in ETFs and passive funds than there are in active funds. Now, what that means for, you know, sort of a capital raising construct means you can't really, at least not yet, raise any meaningful sums of money from an ETF, right? You need active participation from a human being saying, yes, I want to buy into this deal. And now, if we're saying the universe of those investors is shrinking because they're more in passive funds, where's that going to come from, right? It's got to come from somewhere, and it's ballooning, it's exploding in the retail side. And these are individuals who actually care about companies, who are loyal and are long-term investors. So I think it's going to happen in any rate. There's no other way to turn to it. Now, I think the biggest problem we have is fighting this sort of old-fashioned view that wholesale capital markets it only belongs to the institutional investors. And I think breaking through that and saying, hey, actually, you know what, the individuals can play a part. The technology exists to facilitate it, and it can happen. It can dovetail with the investment banking process, and in fact, it can improve the outcomes to the entire ecosystem, being the issuer, the bank, the brokerages, and of course the investors themselves. is a win, and that's a message that people are finally starting to hear loud and clear. I think it's that bleeding of these two sort of investor types is happening rapidly, and I'm very glad that we're on the forefront of it. And if I may, Alokik, just take a step to your previous question. It's an unpopular view, but I have it for some reason. I do have some sympathy for the banks here. Like I sort of talking about open banking. God knows how many tens of billions of dollars they spent acquiring customers, only to now be forced to share that data with potential competitors. I can see the benefits, a consumer-centric approach, and all of it, which is great. But in a world where data is king, I always wonder, why is it only the banks that are being forced to share their data lakes, whilst everyone else, like, why doesn't Facebook have to do it, and so on? And it's just a question that I always sort of wonder about. I'd love your opinion on it.
No, I think it's a really good question, right? And I think it came back to if when we've had conversations with the group that's sort of setting the guidelines and the roles for the open banking across the UK, you come back to this question a lot, and that's why it may have slower take up than it could have, because it doesn't have a commercial incentive for one side of the house, right? Any market needs to have a commercial incentive on both sides of the house. This was largely driven by saying, please come and take from me. Don't need to give me anything. And you can take all my valuable customer information and monetize it in some other way. And I think it's a really interesting question. And maybe there is a evolution of a commercial model that becomes more interesting. It could be, tiny amounts of it, but it could be some kind of commercial, incentives that are driven to allow people to open up this information. Now it comes back to the question saying, it's not really, is it the bank's information or is it the individual's information? So that comes back to Gaurav's point, right? So I think it's a fair point.
Isn't it up to
The other thing, if I might just chip in, the other thing that happens, and I, it's not like we are not, cognizant of Anand's view, and I think it's a very important distinction to make here. But I think the other thing that happens, especially if you talk about big tech, right, like Facebook or Google, right, some of that data is not replicable. It doesn't matter how hard I try, I can't recreate that data, right? Mm-hmm. In banking, I think banks also eventually understand that, and I mean, we are an example of this, right? I mean, we have all the growth that we have seen is without having account aggregation, because people come in and say, you know what, take my PDFs, take my this, take my that, just, I'm going to give you all the information myself, you just aggregate it for me, right? So and I think with financial services, I think banks are seeing this, that even if we kind of start, even if we become we start putting on guards, people will go around that regardless, because a lot of that data is replicable and can be easily consumed by us, even right, without their authorization in that sense, right? But with the explicit authorization of the end user, for sure. And I think what Facebook and Google really count on is, okay, I'm not going to give you my data, give you your data. What can you do? And in fact, the regulatory requirement there is even higher, because it's almost like a protectionist kind of right, regulation that is needed. So, right, and I think that plays into the economics of this.
Yep.
And if I think of open broking, and this is your point on commercial incentive. So when I go to Gaurav, when we launch in India, and I say, hey, Gaurav, I don't want to go to him and say, I want all your data. I want all your customers' data, give it to me, and I want the regulation to come. I don't think that's fair or right. I mean, there's a reason we're plugged into every single or virtually every single major retail network in London and in France, is because we've got a win-win proposition for them. We say, hey, look, we're going to come and offer you product that you're not in the business of offering your clients, and that's sort of investment banking style deals. We don't do stockbroking, so we'll also allow you to acquire new customers. And guess what? There's a revenue opportunity here as well, and it's a win-win. We're best friends. So regulation is nice, but I always think it's the role of the entrepreneur to come in and find a commercially viable way of getting it done.
And I think if we play this out, I think that's a very fair point, right? If we play this out, the analogous factor that goes along with open finance, and the other big topic that we've been thinking through, is sort of embedded finance. And I think this comes exactly back to the point you were just mentioning, Anand, and also, Gaurav, some of the ways that you guys have partnered with companies to offer capabilities. There's a core proposition that any major or sort of successful fintech will offer, and then there's a bunch of other things that they may wish to do to provide this kind of open finance ecosystem or aggregated capabilities, but you don't need to build all of it yourself, right? So maybe Gaurav, when you think about this, can you give us any examples or thoughts of where that may have worked well in terms of offering that embedded finance capability to your vast array of clients, right? I mean, you guys have hundreds of thousands of clients. And so, where has that worked? Where has that resonated? And almost why, if you may?
So for us, I think when we think about it, and like that's a very good point, right? And for every fintech, there's a core value proposition. And for us, the core value proposition is less about a product. It's more about creating that entire picture of a user's financial universe, right? And also then helping them make more sense of that picture, right? So we have actually done quite a few successful integrations, right? We've partnered with startups in India to offer our entire client base international investing, and we have also partnered with larger names like a TransferWise to provide remittance options, like a better remittance option to our user base in India. And as long as you do it, like Anand said, as long as it's a win-win proposition, it doesn't have to be like, hey, you know what, here's my user base and kind of, this is all the data. Like as long as you're very cognizant about how the user actually interacts with the product, and more importantly, if you're very cognizant about identifying the right user who would have a need for these products. And that's where I think the second step for account aggregation comes. So the account aggregation, if you do it the right way, you can build the right set of models to say that, for example, we'll run a model and say, you know what, Anand is a very good client for an international investing account, while Alokik might be a very good client for a digital gold account, right? And that level of micro segmentation, that it's very difficult for a single financial institution, unless they become like really, really big and pervasive, to be able to do that, right? Which is what a lot of big tech can do, because they're like literally into everything, right? I mean, you're browsing and Google knows where you went, right? And you're doing something on your app and Facebook knows what you did. So in finance, of course, that doesn't happen. Thankfully, it doesn't happen. So the account aggregator or the once you have done the aggregation, that is the next kind of logical step to be able to predict what that end customer's needs are, and to be able to predict it nicely. Because one of the things that happens in India, I'm not so sure how it works in UK, like, and one of the feedbacks that a lot of our users give us is they're bombarded by financial products all the time. Because most of the larger financial institutions, they just say that, you know what, send this offer to everyone, send this product email to everyone, right? There's no people talk about micro segmentation, people talk about who's the right customer for the right product, but when push comes to shove, they'll say send it to everyone, right? And that itself becomes, right, I mean, do not call lists that's how they started. Do not call lists started because people would just call you till you would be like, dude, I really don't need this product. So anyways, so we are very big believers that we don't have to build all the products ourselves. We just have to be really smart in identifying the end user's needs and fulfilling them.
I think that's right, and especially when you start overlaying this construct of sort of API access, principles of good data security and preserving the client confidentiality or whatever interest that you may have. I think overall that becomes a good proposition, right? Anand, maybe switching gears a little bit, when you think about companies and their stakeholders, become much more important for investors, right? I mean, and you think about that overall stakeholder ecosystem, to me, I think that's, whether it's the employees, whether it's the governance, whether it's the other ESG factors, etc. There's a much bigger framework there.
Yeah.
Is this actually true when you think about people engaging with some of these companies on a primary basis? And if so, how?
Oh my goodness, it's incredibly true, and we're just at the start of it. Now, we started with retail shareholders, right? These are people who already own the stock, and were just denied access. Then we were asked by a big company, Taylor Wimpey actually is a FTSE 100 builder here, and they said, hey, would you help us get our employees involved as well? And we said, well, actually, we've developed the product coincidentally for it, so yes, let's do it. And the take-up was incredible. And then other companies, employee offers in the UK is a real thing on accelerated deals. it's absolutely unheard of right now. Then we start thinking, well, okay, so let's look at deals that have just happened in the US. I go back to DoorDash and Airbnb because they're so topical. Now, DoorDash is a company which has a number of stakeholders, right? It's got the gig economy workers, it's got employees, it's got consumers, it's got its restaurant partners. What an incredible business building moment that IPO could be for them, right? This ability to enfranchise their stakeholders on a deal. So what we're saying to companies is, up to now, the IPO is just a financial moment for you. And it doesn't need to be just that. It can actually be a massive customer acquisition tool. It can be a huge loyalty building moment for your supply chain and all of it, and let your communities share with your success. And of course, we're seeing that trend. Every company now has this very strong ESG agenda, a governance agenda. And franchising their communities is really, really big. I can imagine that if our product was in the U.S., I can't see any of these mega cap IPOs going public without doing a customer offer. Now, it's important that the customer offer is getting done. It can't be crowbarred in. Like the Airbnb or customer or the DoorDash customer needs to have the Airbnb capital markets experience. It needs to, they need to feel the same way that they do as renting a house as they do buying that IPO share. And that's the difficult bit. That's what we've done and done it really seamlessly. So we're really excited about the upcoming IPO windows and capital raising windows because from a governance perspective and how companies are thinking about stakeholders, it's very much on theme.
Got it. Like I know we're coming up to close to the time, but I wanted to get a little bit more macro questions with you guys as well. So, if we look back over the last year, I like to do these sort of year-end wrap-ups. This festival always comes at the tail end of the year, and it's been an interesting year. Maybe first for Gaurav, what fintech innovation has surprised you most over the last 12 months?
Well, yeah, that's. I mean, I think I would not have expected the rise of online trading to be as dramatic as it has been. I mean, I wouldn't call it innovation in that sense because it's not a new product. It's been around for a very long time.
Right.
But in a bad market, the speed of adoption you saw for online trading is not something that we have seen any time before. Right? Bad markets usually push people away from that sphere. But around like March, April, just the interest that people had, just how quickly that adoption grew, was a bit surprising for us.
Yeah, and to me, it's a combination of a lot of time, potentially some excess cash, and the fact that you're at home and you have more flexibility to do different things as well. And then watching some of these very retail names that people can affiliate to as well has been quite interesting. Anand, turning that same question to you, any thoughts?
Yeah, look, I would sort of frame it, for me, it's what I was really amazed by was how quickly and efficiently the regulators moved in various countries to enable the digitization and to fix inefficiencies. So the two examples I'll give in the UK, our home market, is how the regulator here, the FCA and the preemption group, first said, hey, look, let's unblock capital raising and let companies just raise capital. But then they quickly saw that in doing this, which was in itself a big move and a courageous and bold move, that the smaller investors are getting disenfranchised. Now, very quickly, they amended the guidance to include best practice means small investors need to have their fair share. Pardon the pun. I look in other countries, and Gaurav will know this better than me, but I think my understanding of what's happened in India is, pre-COVID, if I had to open a demat account, a brokerage account, it was a forms like this thick, and I had to sign 100 different places, and it needed a witness and all sorts of things. Whilst what's happened since during the pandemic is they've allowed completely digital onboarding end to end. And Gaurav, correct me if I'm wrong, but that was my understanding. And if that's the case, that's led to this sort of big take up in retail investors in these platforms, and is really smoothened the way. So personally, I'm really heartened by regulatory response.
No, that's super helpful, and I think you're right. If you think about some of the things that have facilitated that if you just focus on India for a second, right? There's that entire India stack between the Aadhaar identity cards that make it, numbers that make it much more accessible, unified payments infrastructure that kind of level the playing field for people to sort of pay each other regardless of the banks and pieces behind it. That's been really powerful in putting something in place. And in some places that's done with a commercial bent. And in other places that's done by sort of government help and support, right? And sometimes when those two pieces come together, you get very, very powerful outcomes. I'm being flashed to wrap up, so I'm going to sort of dive into that. So firstly, I think in the views that you guys have both shared, very much appreciated. I think it's been awesome to have you both come and share these views, because it gives very different perspectives, right? One coming with a retail investor access into a public market construct, into follow-ons and primary raises with Anand, and I think getting the contrasting effect with longer-term goal-based savings and investing, but also trying to round out your personal financial picture with Kuvera in India. It's been really great to get your views. So thank you both for joining. It's an absolute pleasure to work alongside you guys and with you guys as part of our portfolio as well. And it's been great to participate in the Singapore Fintech Festival. So thanks very much. Appreciate it.
Thanks a lot. The same sentiments.
And thank you to Alokik, Gaurav, and Anand for that look at the future of open finance and how it relates to the future of wealth.